Hello and welcome to another trades and tutorials video. In this video, I am going to share with you some day trading tactics that can be used for swing trading as well to help protect yourself against some of the volatility or profit from the volatility. But before I get into these specific tactics, I just want to make sure that if you're catching us on YouTube for the first time, that you know that you can subscribe to our channel and also find more videos like this at marketgauge.com/tutorials. And finally, if you don't already know, in the lower right-hand corner, there is a little gear-like icon that will enable you to see this video in HD. So if you're not watching it in HD, change that setting and the video should become a lot clearer. I think you'll like it a lot better. So with that, let's get started. As you can see, we're looking at the SPY ETF right now, the ETF for the S&P 500, and we happen to be watching it pretty much in the middle of the day on Monday, August 24th. And today was a day of, some would say, somewhat of a crash. In the morning after Thursday and Friday, the market fell out of bed, falling dramatically in those 2 days under the 200-day moving average, which is this gray moving line. And not to say we should have expected a 10 or a 15% 3-day move, but one thing I will note that I don't think I said this in my last blog post, only put it out to members, the consolidation that we've seen since the beginning of the year was the tightest consolidation that the market has seen since 1927. So it was should not be a surprise that we got a dramatic move. Like I said, I wouldn't have predicted a 15% or whatever. It's been nearly a 10% drop in 3 days. But this is the way markets act. And fortunately, what I'm going to show you can help you stay out of the way of unusual moves or not get hurt by them with some really straightforward, ultimately day trading tactics that are applicable to more than just day trading. Now I am going to have to keep this video relatively short, but I'll give you a link to another video that goes into a little bit more detail on this, and I will probably be following the theme of how to look at these markets right now given the dramatic move. Is it a bottom? If it is a bottom, how might we find it? How might we confirm it? And I'll try to pick up the level of videos this week and next since the markets are so volatile. So make sure to keep an eye on your email if you're already a member of Market Gauge, and if not, get to marketgauge.com/tutorials and opt in. But for now, big drop. How do we avoid it? How do we prevent getting caught as a buyer in here and then just holding it down through here helplessly? Hopefully that didn't happen to you. And how might we be able to identify a potential bottom and maybe buy against this low if it's the right thing to do, or buy against the low that winds up being lower? Ultimately, when you have big down moves like this, you don't necessarily know when they're going to stop, but when they do, it's usually a pretty good opportunity. Now, the other side of that coin is how far up does the market have to go before you sell it and get short and profit from an additional move to the downside. So let's take a look at that. But before we do, I'm going to do a little bit of a review. So I've talked about this page before in previous videos. And the page I'm referring to is the Little Big View area of our site. You'll find Little Big View under the Resources tab at marketgauge.com, Little Big View. If you go to /tutorials, you would wind up here, but I've got you in sector summary right here because I want to show you a chart. And the chart is a reflection of historically how many industry groups at the end of the week are positive on a 6-month basis, or I should say industry or sector ETFs are positive on a 6-month basis. And in my prior videos about this, the point I wanted to highlight for you, so if I scroll down on this window, you can see that last Friday or yesterday, the last trading day, the markets closed under the 200-day, or in this case, it's the 40-week moving average, the equivalent of the 200-day. When you're below the 200-day or the 40-week moving average, and you have less than 3, or I should say even 4 industry groups that are positive, it's extremely bearish. Now, you could look at this and say, well, that was cutting it awfully close. I had to know that at the end of the week. But looking forward now, and this was the point of prior videos, the bias here from a sector rotation or sector strength point of view is now going to be negative. So I'm going to talk to you about looking at intraday price action, but let's not forget that if we're under this 200-day or this 40-week moving average, and especially if we're under it and we don't have at least 4 groups, industry groups that are positive, it's a negative condition. So you can see, if we look back, each time the market has pulled back since, and this particular chart goes back into the middle of 2012. If you want historical, more historical stuff and information, there's more charts down here. But the more recent one is up near the top. So since the middle of 2012, every time the market's come down and even broken or touched this 40-week moving average, we've had good support from an industry group point of view. And so I've been highlighting recently that the industry group support has been as weak as we've seen it in years, and if it were to break this line and break the 200, it would be extremely bearish. And so that's what we're getting right now. So in that sense, not a big surprise based on this indicator, but what do we do about it now? All right, it is what it is. Keep an eye on this indicator. Like I said, we update it every week under sector summary in Little Big View. So today's lesson, today's video is really going to be all about looking at the intraday price action to keep you out of trouble, maybe even potentially identify a bottom. But for this video, to keep it relatively short, I'm going to focus on one quick way to look at the markets, and I'll build on it in future videos. And for some of you may already be familiar with the concept that I'm going to talk about, and that is the opening range. And we're going to talk about the opening range on 2 time frames. One, the first 30 minutes of the day. So we're looking at a 5-minute chart of the S&P 500, and let's just pick a volatile day. So 5-minute chart of the S&P 500. The day right now doesn't make a difference. And if we look at the first 30 minutes, I'm on the East Coast, so that's going to be 10 o'clock is the end of the first 30 minutes of the day. And when we get to the end of that first 30 minutes, we look at the lowest low of that period, which happened right here. We look at the highest high, which happened on the first bar. And the highest high determines your opening range high for the day. And the opening range low is lowest low for the day. Now, these 2 levels are going to act as incredible support and resistance for the market. If you look at the market this way, you will never get caught in a massive crash that happens during the day if you view the market as bearish below the 30-minute opening range low. So in other words, you want to be bearish below that level. You do not want to hold on to longs unless you're awfully confident that the market's going to come back. But the bears are in control under that level. The bulls are in control over the 30-minute opening range high. So that may seem very simplistic, but if you combine this with a few important other reference points, in some ways it could be the sector momentum that I just pointed out. More timely or more short term would be the prior day's high or low. Additionally, you can use floor trader pivots, and I'll cover probably all of these in future videos. But for this one, I already covered the sector look that gives us a long-term view that the market's generally bearish. But this red line here also indicates the prior day's low. All right, so if you are below the prior day's low and you are below the 30-minute opening range low, you've got two bearish indications on two different time frames. You don't want to get caught long in that condition. And if you make sure, especially if you're a short-term swing trader or intermediate-term swing trader, and or a even shorter-term trader, and you follow these rules, you'll never get crushed. Now, the other thing that you can do with these lines is look for reversals. Right now, I don't want to look for a reversal back into the opening range low, but if when I'm below the prior day's low, and certainly if the market's in a bearish mode like it is right now. Now in this case, we, I believe, had not entered such a bearish mode below the 200-day or the 40-week moving average, but we were still below the prior day's low. So why worry about the prior day's low? Well, it's a huge level of resistance or a huge level of support. In this case, you can see how even though the market bounced off its opening range low, once it broke the opening range low, it had a good run to the downside, something that if you're a short-term trader, you don't want to get caught in. But if you're looking for a reversal, you'd look for the reversal on a big picture point of view being back into the opening range. And once you do that, you really shouldn't go down below, make a new low of the day. Now, once it gets over the opening range high, which would naturally be resistance, then you're going to look for other areas of resistance that might slow down the bulls who are in control. And there you go. The prior day's low is a obvious area to look for that resistance. Turned out to be the resistance, and then once you got back into the opening range, you're back down. Now this may be considered neutral territory, but it's going to be neutral with a bias towards whatever your bigger picture trading action looks like, right? But for today, just focus on if you are below the opening range low, the market is in a bearish mode. If you are above the opening range high, you're in a bullish mode intraday, and then you want to line that up with the general conditions of the market. So I told you that I would keep you out of trouble and keep you out of the crashes. So let's just take a look. Here's the, let's start here on this day. Here's the 19th. All right, if I scroll forward and we look at the next day, the 20th, right? So the 19th, I guess, was, let me take a look. The 19th was last Wednesday. So the 20th was Thursday. So Thursday gaps lower, gaps below the prior day's low. So here's the prior day's low. And its open 30-minute opening range high and low look like this. Now look at how what I just described would have helped you. If you're looking for a time to be a buyer of this market, you're below the prior day's low, so this is not a good time to buy. If you're under the opening range low, you definitely don't want to be much of a buyer there, given that you're below the prior day's low as well. And you can see how that opening range low was just problematic. This market could not get back above it and continued to trend lower for the rest of the day. Now that is bears in control. Keep an eye on this and you won't get caught in these ugly down days. All right, now next day the market gaps down again. Just give us some perspective on the day. Whoops, I didn't want to go that far. All right, so opening range low, first 30 minutes here, first 30 minutes here. Now I talked about quickly in the beginning of the video when you might want to actually go short. Now in this case, the first day of that I gave you as an example, the 19th, was a better example where the market actually was close to a key resistance level, that prior day low. In this case, we're pretty far from that resistance level, but the message is still the same. A gap down below the prior day's low, you're going to be negative. Right? You're going to be even more negative when what happens? You get below the opening range low. Now, a more aggressive trader would look at the attempt to go above the opening range high. It means the attempt for the bulls to take over, and then failure, go below the opening range low as an opportunity to potentially short with a stop above the high of the day or above the prior day's low. Whether you did that or not, more importantly for this particular video, Buyers beware, you don't want to be a buyer under the opening range low, and it turns out to be an ugly day on Friday. And that brings us to today. All right, so today the market gapped lower. Here's your opening range high. Here's your opening range low. Fortunately, we haven't taken out the opening range low, but do you really want to be all that aggressive in terms of being a buyer above the opening range high? Not really, unless you're really a nimble trader or you've got a really good reason to do so, especially if you have to put your stop really below the low of the day, which is an awfully big stop. But look at how the opening range high has also acted as support even on this big down day. Now, if we get back down below this support level later in the afternoon, that's going to be a pretty dangerous breakdown intraday. And again, that would mean that the bulls tried to resume, tried to show some strength and failed. Now, they haven't done that yet, but if they do, that would be a negative. So as we look forward, in how the market's going to play out, there's a couple simple rules I want you to keep in mind. One, if we're trading below the opening range, as measured by the first 30 minutes of the day, it's bearish. You better have a really good reason to be getting long there, because on an intraday basis, the bears are in control. When the market decides it's going to turn around, there's a very good chance that you will have an opportunity to try and be a buyer against the opening range low, where you're also above the previous day's low. It's going to probably take some patience. It doesn't happen all the time, but it's a much safer bet than trying to buy near the opening range low, where you're below the prior day's low. Right? If you're aggressive and want to look for shorts, then you're going to look for an opportunity where the market tries to take out the opening range high and then comes back into the opening range, and the best times to be doing that are when you're below the previous day's high. Now, there are some other nuances. I'll cover them in future videos, but don't get too aggressive about being a buyer in a down market, and don't think that just because the market's down, it can't go lower. If you use this basic 30-minute opening range rule, you can really, as I said, keep yourself out of a lot of trouble, give you a good sense of where the big picture from an intraday basis the market's going. And it's incredibly powerful. I'll give you some other ways to use it in upcoming videos. All right, so hope that helps, and I will see you in the next video. If you are interested in more information on the opening range, I just did a presentation last week. I don't know how long it will be available. It was supposed to expire today, but I am going to leave it up given the special situation in the markets today, and probably will continue through the rest of the week. I will leave that link on this page in the text. All right, have a great day, and I'll see you in the next video.